Good afternoon, Steve Lentz here from Discover Options. Welcome to this presentation of Becoming a Better Options Trader. This is brought to you by OptionView Systems, and the educational arm is Discover Options. OptionView has been in business since 1983, primarily focused on high-end option analytics. Perhaps you've heard of the OptionView software, and it started way back in '83, and we're now in our seventh generation of OptionView, OptionView 7. And as I said, Discover Options is the educational arm. And here's the website, and it's at DiscoverOptions.com, and we're going to talk a little bit about what we do here, but it's in the context of the title I have here, Becoming a Better Options Trader. Becoming a Better Options Trader. And we know that there is just by the way, I am the Director of Education and Research here at Discover Options. We run our educational arm, Discover Options. We focus primarily, and let me get my little marker here, one-on-one personal mentoring programs. One-on-one personal mentoring programs. And as I mentioned, we're going to talk about becoming a better options trader, and I'll do it in the context of kind of showing you the various angles that we can help you become a better options trader. But as I've promised in the literature that went out about this presentation, we're going to address, and I'll just get it out here right at the beginning, the one true secret to being a better options trader. Now look, since 1983, we have talked to a lot of options traders. I joined the firm in 1998, and I've spoken to and with thousands of options traders. And looking at all the other material out there, you know, including ours, there seems to be, there's so many ways that you can address and approach options. And in coming up with just, if you were to pick one thing to say to help someone become a better options trader, it's this. You ready? Understand fully why you're trading options. Now, there's a lot wrapped up there. If you parse that sentence, understand fully, all right, that's a mouthful there, and it's a mindful, because how many of us truly understand fully options trading? There's a lot to learn, and if you're into technical analysis, you all know that are into technical analysis. Boy, you can go down this huge road here. Understanding options trading by itself is a lot, but listen, understand fully why. Why are you trading options? And so often we'll go to an underlying asset. Maybe you like to trade the SPX, and maybe you're always going, you know, hey, what kind of trade can I put on today? No. Here is the big deal is this. We have to understand, and you have to understand before you click that order button, what it is that you're actually speculating on. All right, I can't emphasize this enough, because sometimes folks will say, hey, you know, I'm bullish this stock, I'm going to put on a covered call. All right. Or, hey, I'm bullish this stock, I'm going to buy some calls. Well, what's wrong with that? The covered call or long calls? Well, each of those two positions speaks to a completely different aspect of what it is you're speculating on. Bullish the stock, yes, one requires a certain type of bullish movement than the other. Big difference. Big difference. And if you want to succeed and become a better options trader, you need to fully understand what it is you're speculating on. Okay? Now, I like to talk about the dog and the tail. I'm sure you guys have heard of the VIX, VIX, and you could trade futures and options on the VIX and all that. Well, the VIX is simply the tail. And what is the real dog in this thing? And that's what I want to talk about first, is the dog or the tail. Are you going to trade options, or are you going to focus on speculating on the underlying asset? We're going to talk about the dog or the tail, and then today I'm going to give you 4 reasons to trade options. We'll talk about the dog and the tail, and then we'll get to 4 reasons to trade options. And that is our outline for today, are these 2 things: dog or the tail, 4 reasons to trade options. All right, let's talk about the dog of the tail. Let's say that you're looking at the S&Ps. A lot of people look at the S&Ps. Maybe some of you are futures traders, futures options folks, stocks, ETFs, other indices, but you have an underlying asset is what we call it. The underlying would be, in this case, the SPX. Cash options on the SPX trades over almost $1.5 billion a day. Tremendously liquid market. Huge, huge options market going on surrounding the SPX. All right. Now, this is what we would call the dog. All right. This underlying asset would be the actual dog. All right, and then relative to each dog, if every stock represents a different dog, ETF index is a different type of dog. Here, the SPX might be this husky. Maybe there's a stock that's a German Shepherd. Maybe an ETF might be this little terrier here. Okay, now every one of these optionable markets trades options. All right, roughly a couple thousand options markets out there in North America. A little bit more than that. Okay, now down below I'm showing you here the implied volatility of the options. Now maybe you've heard of IV, implied volatility. The scale is over here. It's the volatility level implied by the cash value, the extrinsic value of the options for this underlying asset here. And those of you that follow the VIX, you know that when the market goes down, implied volatility tends to go up. See that? Likewise, when the underlying asset goes up, implied volatility options tends to go down. There's typically an inverse relationship here. That's not always the case. So get this though. Here you have the dog being represented by the underlying. The tail is coming from the options. Okay, the dog wags the tail. The underlying movement here, all right, the movement of the underlying determines the options pricing. In the case of indexes crash, the options get really expensive. So what I'm encouraging you to do is understand what it is about the underlying asset that you're going to speculate on. And that's the key to really to becoming a better options trader, is focusing on understanding what it is you're speculating here. All right, and we're going to go into 4 reasons to trade options and what it is you're going to speculate on and how to go to the options market and exploit that. You could just go along the spiders, right? You could short the spiders, SPY, but in the options world, that's the tail here coming from the options market, okay? You can use options to kind of bend the risk and reward probabilities in your favor. And instead of just simply making money if it goes up and losing money if it goes down, no, we can now start bending that risk and reward possibility for you and giving you a greater opportunity for success. And that's what trading options is all about, is it gives so much more flexibility and an ability to enhance your yield with lower volatility. It just blows open a whole new world of investing and trading and exploiting your speculations on the market. Now, some people don't like speculation. The word I'm not a speculator. No, listen, are you in business at all? Every business is speculating in a sense, right? You roll out a marketing effort, you invest in that marketing effort, you are speculating it's going to work. All right, every aspect. If you go into a new market with your business, any corporation goes into a new market, a new product, they're speculating that it's going to succeed. All business requires and is really based upon speculation, probabilities, etc. And that's really what trading options and trading stocks, futures, indices is all about. All right, so here's an example. Now, how are you going to piece all this together? How are you going to combine this stuff to where, okay, I'm speculating on the underlying, I know that in the options implied volatility can fly all over the place. Market comes down, these go up. How can I wrap all this together in one nice picture so that I can really see what the best option trade is? Because this is a lot. Listen, hey, I know more than anybody. It's hard enough just to simply speculate on the underlying itself, much less understand the options pricing that goes on. All right, and so this is where high-end options analytics comes into the picture and can really help you understand the possibilities. All right, now here are two positions. This is OptionView's graphic analysis screen. Let me just explain what you're looking at. If you're just starting out in options, or even if you're an intermediate or you're advanced, I think you're going to find something here that really is beneficial to know. This is a graphic analysis, and perhaps you've seen this in other magazines and everything. And for me, when I started in options trading in the 1990s, I'd read articles. I'm just starting to dabble in options. I'd see these graphs and go, yeah, I'm not ready for those graphs yet. I'd read more about options and their success stories, but eventually, folks, you have to dive in to these risk graphs to help you make the better decisions. Again, it's about speculation, understanding what you're speculating on, and now finding that option trade that bends the risk and reward in your favor. So here's what we're looking at here. X and Y axes here. X axis is the price of the SPX goes up as we move to the right. If SPX goes down, we move to the left on the x-axis. Y-axis is the yield on your investment. Anything above the zero break-even is gain. Anything underneath the break-even, this zero break-even line, is loss. All right, so let's look at the red line first. The red line, this is simply going long a call option. Long a call option, and you can see if we go long this call, and in 5 days from now, all right, after 5 days have passed, if the XPX goes up 2%, it looks like we would be up about 120% or so. You see that? Let me get a little pencil. You got to understand these graphs because this is kind of where you can take it to the new level. Again, SPX goes up 2% in 5 days. That's 2% gain. How much would we make in 5 days if it does that? Looks like we're at about 120, 115, 120%. On the red line, this is the call, the long call. If SPX instead goes down 1.4%, looks like we would be down 50% on our investment. Okay, so that's the red line. That's going long a call. Now, you might say to yourself, you know, that just seems really volatile. Either I'm up 120% or I'm down 50%. That's just crazy, right? No, no, no. In options, we can do what's called spreads, and that's what I'm showing here on the green line. This is an option spread, and let me wipe this out, okay? Clear out all that. Okay, this is the green line here. Watch at the green line. If in 5 days we're up 2%, it's about a standard deviation move or so, looks like we would be up about 25% on that investment. If it goes down 1.4, looks like we would be down about 15. Much less volatile yield on your investment when you do option spreads, and that's the beauty of this. Now, one thing that I'd like you to consider, if you don't already have OptionView, I'd encourage you to at least get a trial and then consider buying it if you're serious about getting into this, because you can quickly superimpose multiple positions to evaluate which one is best, either a spread or a long position in a call or a put, to best exploit what you're speculating on. And that's what high-end analytics are all about. And we're factoring in these lines, shifts in implied volatility that I just described. When the SPX goes up, implied volatility goes down. That's already built into these lines here. if the market crashes really fast in 5 days, okay, we know that implied volatility is going to rise. That's factored already in here. You don't have to take a stab at guessing how much that shift is going to be. Option view looks in the past and then extrapolates into the future. From that, extrapolates that and broadcasts into the future those shifts in volatility. And you're not going to find that level of sophistication anywhere on any broker's platform, no matter who they are. I mean, we're in touch with our competition. They don't even want to go down that programming road because they'll be doing it forever. We have been doing it forever, since 1983, perfecting these kinds of predictions into the future based upon shifts in volatility and all that, okay? So, high-end stuff, and you can make very accurate decisions here. One feature that's nice is, let's say you're bullish. Here is the long call position that I just showed you here. We're reflecting the red right here, this red line. You can make a lot of money if it goes up a lot, right? And you can lose up to 100% of your money if the market goes down. That's what we're showing you here, is that taking the bar chart, broadcasting in the future, you can see that with the long call position, we need the market to go up. And it's kind of shaded darker green because you can make a lot of money out there. Now watch this. I'm going to show you the same graph only for the option spread. Watch this. The next slide is here. That's the option spread. Look at this. Even if the market does nothing, just chops along, you still make money in the green. It can even go down a little bit to 1740. We still make money on that option spread. Spreads can be very, very forgiving like this. You don't have to be so precisely accurate. And that's what you can compare, going long the call, doing the option spread like that. And that's just the beauty, again, of having high-end analytics to help you make your decision. Okie dokie. All right, why trade options? We got 4 reasons to trade options. Before, just let me get a sip of water, clear the throat here. One moment. Why trade options? 4 good reasons for you to trade options and speculate, and how you can speculate in the underlying and exploit those in the world of options. First, as I just said, use leverage to speculate on large, fast moves in the underlying assets like stocks, futures, contracts, or indices. All right, if you have a good knack for finding stocks that are going to explode, and let's say that you kind of nailed it a couple times and you have a methodology that's pretty good. Maybe it's earnings, maybe it's announcements, all right, FDA announcements, and you have a knack for doing that where you're pretty good at predicting when something's going to really explode, 1 to 3 standard deviations in a direction. You can come to the options world and make a lot more money than if you're just going to go long the stock or short the stock. Further, you can bend your risk and reward to be very, very fruitful with this. And we offer our courses in level 1. We have a great session on long calls and long puts. And we go over the whole parameter, which strike to consider, how far out in time you go, and all that stuff. Okay, that's level 1. And so here's another example. Let's say that you want a nice explosive move in 10 days. You think something's going to really blast off and you want to make sure you capitalize on it. Here's a long option position where if it happens to go up, say, 4.6% in 10 days, you're going to make almost 600% on your investment, 6 times what it is in this particular trade. You could lose all your money on that stock, on that option, 100%. But if you make out and you're correct, you can bend this to make 6 times what it is you're risking on this trade. And that's a benefit of working in the world of options. Rather than having a reward to risk of 1 to 1, here we've bent it to be roughly 6 to 1. Pretty good, huh? And so that's one reason to trade options, is to exploit your predictions of explosive moves. All right, what's another reason to trade options? Okay, we get money managers coming to us and saying, hey, you know, I want to kind of branch out a little bit, you know, callers, covered calls and all that. Look, you can use options as an overlay. We call it an options overlay to reduce the volatility of your returns and increase yields on long-term holdings. Let's say you're holding a group of stocks or ETFs. You can use overlays. You know, you got these long holdings. You can use covered calls and collars to then complement those long holdings, and at the end of the day, reduce volatility and increase your yields. Okay, so let me show you a very important chart. Oh, and by the way, we cover this in level 1. In our mentoring program, we cover covered calls, campaigning with covered calls, and we also cover callers as well. And these are the aspects of an overlay that you can consider. Let me show you a very important slide from level 1. This is showing you returns over time, 2007 through the end of 08. 2007 through the end of 08. Very, very difficult time in the market. And I'm showing you here the SPX in blue. Notice how the SPX in blue, going into 07, we had about a 25% gain in the SPX by near the end of 07. And then, of course, that's after that, going into 08, in the fall of 08, just a crash in the SPX. You see that? Boom, just a huge drop. And at the end of the day, you know, we were down 40% from the beginning of 07. Even more than that if you factor in the high of 07. It was a bad, bad crash in the market back then. Now, that's the broad market, the SPX. Now, let me show you. Had you used, oops, timeout. There we go, click. All right. We teach a covered call approach here in the pink that would have saved you a whole bunch. Instead of being down, you know, at the end of the day, over 30% in 2 years, you would have been down only about 15%. All right, you would have been down only half as much just using a base covered call approach that we teach in level 1. Now, we teach an altered form of a covered call. We call it modulating covered calls, and that's a second approach to covered call writing. And you can see there we would have ended up flat. After all that, by having a good covered call overlay that makes a lot of sense, in those 2 very, very rough years, you would have ended up flat. Now, we teach a collar approach where we're also throwing on not only covered calls but also protective puts. And we modulate both sides in and out of the market. We give you the trading rules to do this. You would have actually ended up ahead, up about 5% in that period of time. And so in this series of courses, you would receive enough information to, as a money manager, have a practice that's thriving and really helping out people in their investments to not lose it all and to reduce the volatility. This collar, look how this blue line doesn't go up and down very much, does it? All right, you've reduced the volatility of the returns dramatically by using an options overlay. I got to tell you, I'm mayor of the town that I live in, and we have some pension plans that are privately, managed. They're not managed at the state level. We have commissions. I appoint people on these commissions to oversee these pension plans, and we have all these rules that the public money has to use. We have to use an outside advisor and all this. I wish in the crash of 08 that we had option overlays working. I didn't become a trustee or a council member and the mayor until after this crash happened. But looking back, I wish I could go back and say, guys, please send some of this into an options overlay approach and save some consternation down the road. Okay, so we'll teach you all this. That's again in level 1. Okay, reason number 3 for why to trade options. All right, let me take a sip here. Look at that just a second. We can use leverage to speculate on slower moves in the underlying asset. You may not be real good at timing a big move in the market or in a stock or an ETF, but you know what? Maybe you're good at analyzing the fundamentals and knowing or having a good deal of confidence in that there might be some macro situation that should result in longer term movements in an underlying asset, either up or down. Well, instead of just going long the ETF or stock or short the ETF and stock and having a 1-to-1 reward to risk ratio, you can use spreads, longer term spreads, to exploit what it is you're speculating on. In level 2, we cover option spreads. Level 2, we cover option spreads. And so here's an example of a spread in SPX. Now this is over a month. You could go out even a year if you want. This isn't just a few days. We're going out 40 days here. It may as well say upward, a year if you want. You could get the same kind of risk reward here, but here we're going out 40 days, and I'm just showing you now multiple time frames. The dotted line represents today's time frame. If today it goes up 2%, you'd make roughly 10% on your money. That's 2% here. We're up about 10 when I look over here, okay? But in 40 days, you can kind of see here, if it goes up 2%, okay, we're going to be, if it goes up 2%, we'll be up, say, roughly almost 20% on our money in 40 days. If it goes down 2% to here in 40 days, well, we're still going to make money. Look at that. In fact, it would have to drop all the way down to about a 3% drop in 40 days for us to actually then begin losing money. And even then, we're not going to lose as much money as it is we're trying to make, unless it really crashes here, of course. But you can bend these risk-reward graphs and put in multiple trades and superimpose and compare and contrast them all to come up with a good look that fits your prediction for that underlying market, stock, future, index, ETF, whatever it is. Okay, again, longer term investment, you can use options, better than just the 1-to-1 underlying. And here's what this trade would look like. Look at the forgiveness it has. Let's say that you don't time this. Maybe the market does eventually end up going up slowly, but it might go down first here and then come up. Much more forgiving using these longer term spreads like this. Look at that, even in 40 days, it can come all the way down here to 1670 or so, and you still make money here. Much more forgiving, and that's the beauty of options here. Finally, you can use leverage. This is why I got into options back in the 90s. Use leverage to speculate on the lower volatility of movement in the underlying asset. And this would be a non-directional approach. Maybe you've been pitched this before. The notion here is, hey, you can make money no matter which way the market goes up or down. And you know what? That's a very true statement. There's strategies you can use to make money no matter which way the market goes up or down. But again, you need to know what it is you're speculating on, right? Remember that. Okay, and in level 3, we teach condors, butterflies, we teach about volatility, and this is for the more advanced folks. If you've been trading options for over 6 months and you've been getting into covered calls and spreads a little bit, you might be ready for level 3. Well, we're now going to go look at condors and butterflies, a little bit of calendars, and really take it to a new level, to where it is you can then put on something like this. This is a broken wing butterfly. 3 legs, kind of an odd positioning of the contracts. Okay, this is a broken wing iron butterfly. And notice here now we're looking 32 days in the future, but the market could go up 2.3% or down 2.3%. and you're going to still make money on that. In this case, you would actually make probably 20% on your money no matter which way it goes if it's in 32 days, within 2.3% in either direction. So now you don't really have to predict which way it's going to go, so long as the market stays in a kind of a tighter range. And so if you're good at speculating on markets and predicting, okay, the news is out now, it's made its move, now we're going to chop around for a bit, boom, you put one of these types of trades on, and you know that you're speculating on a tighter range movement, you can now make money even if the market drifts up or down, so long as it doesn't blast off in either direction. Okay, you're going to make some good money here, some pretty good yields. And look at this, in just 16 days, 2 weeks, you can make around 14% if it stays right where it's at. Not too bad if you're looking for 5 to 10% yields pretty quick. Okay, you could get that in just between 1 and 2 weeks. And so again, that we understand what it is we're speculating on, okay? This is level 3 in our mentoring programs. Let's see, let me look at a question here, one moment. Well, Barry is asking an interesting question. He says, what do you do if it does blast off in one direction on your iron condors? On your iron condors, if the market does blast off, and you might have a look like this or the butterfly, the question being, what do you do? What do you do? Well, at some point, remember, Barry, you're speculating on a lower range move of the underlying. And if it violates your speculation, if your analysis is incorrect and the market blasts off and higher volatility ensues, you have two choices, Barry. One, you can just exit the position and take your loss because your speculation, the analysis you made, turns out to be incorrect. All right, and certainly in the case of directional trades, if your analysis is incorrect, you need to have a stop loss that alerts you that your analysis was incorrect, the market's violated your analysis, and now you just get out. Don't ask questions, cut your losses and get out. Now, in the case of a condor or a butterfly like this, if your analysis is shot, you can certainly you need to have a stop loss in which you just bail and get out. Now, that's one approach, is to just get out. The second approach is to make an adjustment. And there's a ton of different ways of adjusting your condors and adjusting your butterflies. Okay. Now, we do teach how to make those adjustments. Okay, and some would say it's an art. I don't like to say that it's an art. We like to teach it as a science. And what we do is we have our adjustment approach. We've back tested it, we've forward tested it, and that's what we teach in our condors, is an adjustment approach to the markets. And we like to really put it on seasonally at a certain time every month. And then we only focus on markets which we call chronically overvalued. Now, I don't have a slide to demonstrate this, but we only are interested in selling premium like this in markets that habitually do not move as much as what the options premium is implying. Okay, let me go back up here. All right, let me show you this. Okay, which slide is it? This one. Okay, this is a good one. This is a great little picture here. Now watch this. Here we have a situation where the implied volatility of the options is in blue. The red represents the realized volatility or the statistical volatility of the underlying itself. Okay, two entirely different things. Now look at this. When the market is going up, okay, the price bars are somewhat narrower. You see that? And in that situation, the statistical or realized volatility is falling. When the market begins to come down, the bar and you can see that the bars get wider. Statistical begins to climb, and in a big drop in the market, an impulsive move down, the statistical or realized volatility climbs pretty strong there. See that? And so what we like to do is focus on markets where the implied volatility, the blue line of the options, is on average higher than the realized volatility. So that the options in the SPX are on average implying higher volatility than the volatility that the market actually brings to pass. That's chronically overvalued options, and we want to focus on those types of markets. Now, you need volatility charts to find those, to get that information. And we provide that for all of our OptionView users, is an easy way of finding those markets that are chronically overvalued like the SPX. Now look, there are some markets that it's inverted. The blue line is underneath the red. Those are chronically undervalued options. You do not want to sell premium neutrally, condors, butterflies, all that stuff. No, in those undervalued markets, you want to stay away. Run away. You can trade them directionally, you know, taking directional shots, but do not trade condors and butterflies in chronically undervalued markets. You'll be beating your head against the wall. The market's going to be blowing through your stops all the time. Okay, so that I think answers that question. Okay, yeah, John, I didn't make my thought complete there. We talked about art and a science. Okay, risk management can be you know, art and science. Options trading, many people say it's a craft, it's an art. No, no, no. It starts out as a science and becomes an art. Okay? But you have to master the science first. You have to master the science first. And we offer back trading tools for you to perfect in practice in the past, the science of making adjustments, and then moving forward when you're actually scrimmaging in the markets and trading full boat in the markets, now it can become more of an art. Think of like playing a piano. All right, if you know, and many of you have children, maybe you did the same thing we did. We had to get the proverbial piano in the house. Kids had to learn to play piano. It was required. They hated it. You go to the recitals. You do the cookie and punch thing. They're sweating at the piano. It's all the keyboards are wet. They're wiping it down with a towel. I think many of us have been through that American tradition. We did it. All right. At the beginning, piano playing starts out, it's definitely a science. There's no art to it when a third grader is playing the piano. However, if your kid sticks with it, and they go into high school and they're an amazing piano player, now they're able to make it more of an art form, right? Beautiful music coming from a kid that, if he's been playing piano since the third grade, makes it to high school, now he's really creating some artful music. And same way in options trading, at the beginning it has to be a science in your adjustments, in understanding some of these things, and it's very mechanical at the beginning, but as you get more attuned to it, you get to start to understand the flow of implied volatility relative to how the underlying moves. Now it can become an art form for you. Then it becomes a craft, but it always starts out as a science. Okie dokie. All right, let's see. Anything else? Oh, I know. You see this graph here? You can make money no matter which way the market goes. I wanted to point out to you on something new that we just posted here. Up at the top, go to DiscoverOptions.com. Those of you that have an account, do not log in right away. Do not log in, because then you'll see this brand new feature up here. Free option strategy report, 83% winners, download now. You'll have to click that, enter your information all over again, all right, and then we'll send you a PDF of a report that I put together on a non-directional strategy that the risk graph looks very similar to this. It's not taught in our mentoring class. It's just something I put together on a strategy that pencils out really, really nicely. I think you'll find it very interesting, and it's just a taste of some of the things we do here at OptionView in providing various strategies so that it can complement what it is you're going to speculate on. And this is a non-directional, so if you're predicting a market is chronically overvalued and isn't going to be as volatile as what the options are implying, well, that free strategy report will bring a strategy to you that you might want to consider. Aside from that, you have the level 3 stuff we just talked about, and that and our software showed you the educational stuff we do. I hope that you come away with some good reasons to trade options and become a better options trader. The secret again is what? Understanding fully why you're trading options. Noodle on that. That's my new term now. Noodle on that. Think about that. Meditate on that. When you're reading, when you're reading other blogs, watching other presentations, ask yourself, what am I truly speculating on here? What am I speculating on? And if you cannot answer that question, you need to back up, okay? Hit the books a little bit and meditate on that more until you can actually articulate it well for yourself. And that's the takeaway today. And of course, we can give you the tools to really dive down and become that better options trader and really take it as far as you want to go using the tools and educational offerings that we have. Okie dokie. Any other questions, comments? Want to thank you again for attending here today. Boy, Jay is asking a good question. What account size do you recommend for complex spreads? Jay, you know what? You can get into some complex spreads on some of the ETFs with very, very little money. Now, the less money you have, then the less you're going to make. When you make 5, 10, 15% on a spread, well, if you're only trading a few $1,000s, well, you might not think it's worth it to yourself to do that. All right, but know this, on the spreads that we teach, okay, you can make 5, 10, 15% certainly on one trade in a given, say, 2 to 4 week period on a given trade. Now, you're going to lose sometimes as well, okay, but you can kind of back into that in terms of what is your time worth. Because you can open a trading account for just a few $1,000, trade little one lots and pick up $10, $15, $20 here. Is that worth it to you? Probably not. But for someone else, it might be worth it. For the student, and we have college students that come to us, they want to get a head start before they get their first job and they're exploring it, then it's fine. So it kind of speaks to you and the time value and what your time is worth in that respect, okay? But trading these complex spreads in ETFs is entirely viable, especially on the SPY. When you have penny-wide spreads on the bid and ask spreads on these options, it's good stuff. So hope that answers your question. All right. All right. There's our phone number. There's our website. You can go to it and dive in. And if you have any questions, please call, talk to our folks here. Look, we can piece together various courses in an a la carte type of fashion as well, and then bundle it for a discount. You just got to call, talk to one of the reps here. Love to talk to you about piecing together a course that matches your needs. Excellent. Folks, thanks so much for joining us. Till next time, happy trading. We'll talk to you later. Bye-bye.